After studying this module, we shall be able to understand the importance of dividend decisions in firms, know the investment behavior of two classes of investors, one preferring dividend and the other preferring capital gains, understand residual theory of dividends, explain different forms of dividends and their bearing on firms. As we know that dividend is a part of net earnings distributed to the shareholders of firms, dividend decision is an important decision which has a bearing on investment and financing decisions of the firm. A firm's objective is to maximize shareholder value. Therefore, it is quite a task for the managers to decide about the right balance between distribution of dividends and retention of earnings so that they are able to maximize the shareholder value. Now we will understand what are the issues that the management has to address while deciding the dividend policy. The issues are the investor's preferences. An investor is concerned about maximizing his return, which is in two forms: capital gains and dividends. One class of investors may prefer dividends as it satisfies their need for current gains, while the other investors class may prefer future capital gains. The management has to fulfill the desires of the investors, keeping in mind the present investment opportunities available as well as the external financing conditions in the market. Another issue that emerges is to decide upon the payout ratio. It is the proportion of earnings paid out as dividends to shareholders, typically expressed as a percentage. It has a significant bearing on a firm's value. A high payout ratio will have lesser retention ratio. Retention ratio is defined as 1 minus payout ratio and vice versa. Yet another important issue that follows is regarding the use of retained earnings. The retained earnings are churned for the growth of earnings, which indirectly results in the capital gains in long run for the investors and appreciation in share value. A high payout decision indicates emphasis on higher current dividends and lesser retention for the firms. Also, it is not advisable to raise capital at higher rate as the cost of retained earnings is lower than new equity issue. Therefore, the managers have to strike a chord between dividend, investment, and financing decisions.
An investor is concerned about maximizing its returns, which is in two forms: capital gains and dividends. One class of investors may prefer dividends as it satisfies the need for current gains, while the other investors class may prefer future capital gains. The management has to fulfill the desires of the investors, keeping in mind the present investment opportunities available as well as the external financing conditions in the market. If the investment opportunities yield higher returns than the cost of raising external equity, it is better to retain the earnings and reinvest them. Another issue emerging from the above issue is to decide upon the payout ratio, which has to be given out to the shareholders. Payout ratio is dividend per share over earnings per share. It has a significant bearing on a firm's value. A high payout ratio will have lesser retention ratio. Retention ratio is defined as 1 minus payout ratio, and a low payout ratio will lead to higher retention ratio. Again, it depends on the existing investment opportunities available for the firm. High return yielding opportunities require funds which can be provided by retaining more earnings and paying lesser dividends. Thus, the retained earnings are churned for the growth of earnings, which indirectly results in the capital gains in long run for the investors and appreciation in share value. A high payout decision indicates emphasis on high current dividends and lesser retentions for the firm. The earnings growth may be slow and hence may lead to lower market value of the share. But again, it might not be true considering the imperfect markets and uncertainties in future. Increase in share price in future is a bit difficult to predict as it is affected by various factors, whereas dividend is a current income.
We will understand why the dividends are important for the shareholders and the firms. Theoretically, dividends and capital gains are perfect substitutes in the absence of taxes and transaction costs on them, respectively. But still, an investor prefers dividend over capital gains due to behavioral motives like self control and aversion to regret. Investors have an inclination to preserve their capital and spending dividends. Dividends are also perceived as containing information content. The market reactions to stock prices vary as per announcements of dividends. Basically, the idea is that management, instead of announcing about companies' future prospects, can increase or decrease dividends depending on the situation. Clientele effect means a set of investors are biased towards a particular type of security, which tends to affect the price of the security as per the situations. Thus, clientele preferring dividends prefer to invest in companies giving dividends on regular basis. If there is a sudden downfall in the dividend payout ratio, investors switch to companies paying high dividends and the price of security will fall. There are some doubtful reasons too behind dividend payments. The first one is bird in hand fallacy. Investors are undoubtedly more concerned about getting dividends, which are more certain than capital gains. And hence, due to the less riskiness of firms paying dividends, the investors discount them at a lower cost of capital. The second reason is when firms get temporary excess cash flows earned from activities other than operations. They may try to distribute it to the investors in form of dividends. They should also foresee the future opportunities or projects where the funds may be required. It is advisable to keep funds for internal growth purposes, which will automatically improve the value of shares.
Some countries charge taxes on dividends to the investor, and there is a cost involved in raising fresh equity. But still, investors prefer dividends. There is a set of conceivable reasons and doubtful reasons behind it. The possible reasons are investor preference for dividends. Theoretically, dividends and capital gains are perfect substitutes in the absence of taxes and transaction costs on them respectively. But still, an investor prefers dividend over capital gain due to behavioral motives like self control and aversion to regret. Investors have an inclination to preserve their capital and spending dividends. Therefore, dividend payment provides a cushion for self controlling investors who have spendthrift tendencies. Sometimes, investors psychologically apprehend the consequences of selling stocks that the stock price may raise after their selling. Hence, this aversion of regretting propels them to prefer dividend over capital gains. Information signaling. Dividend payments are sought as a signal to the investors about the future prospects of a company. The market reactions to stock prices vary as per announcements of dividends. For example, if a firm has stable dividend policy over a period of time and it is changed, investors may think that the future prospects of the company are promising. Basically, the idea is that management, instead of announcing about companies' future prospects, can increase or decrease dividends depending on the situation. Clientele effect means a set of investors are biased towards a particular type of security which tends to affect the price of the security as per the situations. Thus, the clientele preferring dividends prefer to invest in companies giving dividends on regular basis. If there is a sudden downfall in the dividend payout ratio, investors switch to companies paying high dividend and price of security will fall. Therefore, The management should consider the clientele effect too while deciding about the dividend policy of their companies. The doubtful reasons behind dividends are as follows. Bird in hand fallacy. Investors are more concerned about the fact that dividends are certain than capital gains are, and thus dividend paying firms will have higher value as the investors will discount them at lower rate of required return due to lesser risk associated with such firms. But this argument is fallacious. An investor can reinvest the dividend earned in the stocks of the firm having similar characteristics as the stock paying the dividend. Temporary excess cash. In situations when firms have excess cash earned from other activities than operations, like windfall gains, they tend to distribute dividends. But they should also foresee the future opportunities or projects where the funds may be needed. It is advisable to keep funds for internal growth purposes, which will automatically improve the value of shares. Raising fresh equity from market is an expensive affair as it involves huge costs of issue and flotation. So, it is better to use retained earnings for future capital expenditures rather than paying dividends.
The main question when it comes to dividend decision in the mind of the finance manager is whether dividend payment is relevant or not. It is argued in theory that dividend payment can have an impact on the market value. The school of thought which propounds that dividend is relevant propagates that a company paying high dividends will have a higher market value because a firm paying higher dividends is considered less risky on account of certainty principle and hence it is discounted at a lower rate of required return and therefore the market value will be high. These theories work on the premise that dividend decision and investment decision are related. Residual theory of dividend. As per this theory, the dividends are considered as passive residual. It suggests that the dividends should be paid after preserving retaining earnings for the future investment opportunities. Basically, the investors are indifferent towards dividend payment and capital gains. Therefore, if reinvesting the earnings in profitable investment projects can earn better returns, the investors are contented to part away their dividends to get higher capital gains in future. On the other hand, if lesser and unprofitable opportunities exist, it is better to pay dividends. The basic idea behind using retained earnings for future projects is that if earnings are not retained and distributed as dividends, the firm will have to resort to raise external equity from market at a higher cost due to various other costs included.
Residual theory of dividend proposes that the investors are indifferent towards dividend payments. Thus, companies treat retained earnings as a method of financing. Dividend payment becomes a function of financing decision for the firm. In such a condition, the firms have to decide whether they should retain earnings or distribute them in the form of dividends and how much should be distributed. This decision requires that the firms should be able to foresee the future investment opportunities. If there are abundant opportunities available, dividends should not be paid. Investments should be financed through retained earnings, then issuing new stock. In scenarios where no investment prospects exist, the dividend should be paid. This means that the firms should have a dividend policy matching these two extreme situations. If the firms can earn better returns by investing the retained earnings, the investors are happy to part away with dividends to earn higher capital gains in future. It requires an optimal dividend policy should be there. Optimal dividend policy is defined as the dividend policy that strikes a balance between current dividends and future growth and maximizes the firm's stock price. It is advised when the dividends are viewed as passive residual, firms should adopt a smooth residual dividend policy instead of pure residual dividend policy or a fixed residual dividend policy. A pure residual dividend policy is a policy whereby a firm pays out all sums left after meeting all charges against earning, taxation and planned retention of earnings for capital expenditure. Under this policy, dividends are likely to fluctuate sharply with variations in earnings and changes in investment plans. A fixed dividend payment ratio policy is a dividend policy where a corporation establishes a dividend payout ratio and applies this to earnings, the fraction of earnings paid out as dividends. This policy ensures that retentions as well as the dividends fluctuate with earnings. But with given investment plans, outside finance will sometimes be required and reserves will be affected by dividend policy. A smooth dividend policy is one designed to produce smoothly growing dividends. With this policy, dividend payments are unlikely to be changed due to temporary fluctuations in earnings. Instead, the permanence of any change in earnings is assessed before any change is made to the dividends. Let us discuss these in detail with the help of visuals and animations.
There are basically three types of residual policy. These are a pure residual dividend policy, a fixed dividend payment ratio policy, a smooth dividends policy. We shall discuss these in detail. A pure residual dividend policy is a policy whereby a firm pays out all sums left after meeting all charges against earnings, taxation, and planned retention of earnings for capital expenditure. Under this policy, dividends are likely to fluctuate sharply with variations in earnings and changes in investment plans. A fixed dividend payment ratio policy is a dividend policy whereby a corporation establishes a dividend payout ratio and applies this to earnings, that is, the fraction of earnings paid out as dividends. This policy ensures that retentions as well as dividends fluctuate with earnings. Outside finance might sometimes be required, and reserves will be affected by dividend policy. A smooth dividends policy is the one that is designed to produce smoothly growing dividends. With this policy, dividend payments are unlikely to be changed due to temporary fluctuations in earnings. Instead, the permanence of any change in earnings is assessed before any change is made in dividends. It is advised when the dividends are viewed as passive residual, firms should adopt a smooth residual dividend policy instead of pure residual dividend policy or a fixed residual dividend policy. Payment of dividend. There are three ways in which the firm pays dividend, namely cash dividend, bonus shares, and share repurchases. Companies usually pay dividends in cash. While dividends have to be paid in cash, the company has to make sure that sufficient cash is available. If not, then decide how much funds need to be borrowed. Moreover, cash dividend reduces the assets of the company as it has to be paid out of the cash account, and dividends are paid from the reserves account. Hence, both the assets and net worth reduces. Another way of paying dividend is issue of bonus shares. Bonus shares are also called stock dividend. Some firms use the strategy of issuing bonus shares to combat the issue of paying cash dividends. In issue of bonus shares, existing shareholders are issued new shares from the free reserves on pro rata basis. But this has no impact on the dilution of ownership as it is just an accounting treatment of recapitalization of reserves and surplus, and hence net worth of the company remains unaffected.
Cash dividend. Companies usually pay dividends in cash. Companies have to plan accordingly when they have to distribute cash dividends that whether sufficient cash is available. If not, how much fund is to be borrowed. Companies prefer cash budget at the time of dividend payment, mostly when a stable policy is followed. Otherwise, It is really difficult to plan for cash when unstable dividend policy is in practice. Moreover, a cash dividend reduces the assets as the company has to pay out of cash account and dividends are paid from the reserves account. Hence, both the assets and net worth reduce. Another way of payment of dividends is issue of bonus shares. Bonus shares are also called stock dividends. To combat the issue of paying cash dividends, some firms use the strategy of issuing bonus shares. In issuing bonus shares, existing shareholders are issued new shares from the free reserves. The shareholder is entitled for these new shares on pro rata basis, but this has no impact on the dilution of ownership, as it is just accounting treatment of recapitalization of reserves and surpluses, and hence net worth of the company remains unaffected. There are some reasons why companies prefer issuing bonus shares. Bonus issue of share brings market price of the share within a popular range for active trading. Bonus issue increases the number of outstanding shares, that means the trading activities will increase. It increases the size of share capital, which boosts the reputation of the company. It helps in conservation of cash, which can be employed in profitable investment opportunities. Thus, earnings are retained in the company, and on the other hand, shareholders are satisfied by getting bonus shares. But in India, shares cannot be issued in lieu of dividend. Thus, this reason is weak enough to support this reason. In situations of financial difficulties or a contractual constraint to pay the dividend, bonus can become a savior to maintain the confidence of the shareholders. Let us now discuss why do the shareholders value issue of bonus shares. Cash dividend is taxed as it is considered as a part of the ordinary income for the shareholders. Capital gains receipts. Taxes on cash dividends are higher than capital gains receipts. Thus, an investor can sell the bonus shares and incur lesser tax on capital gain receipts, keeping intact the principal shares. Again, as per Indian law, tax on capital gains is there while dividends are tax free. Therefore, bonus issue is not a cup of tea for Indian investors. Shareholders perceive a bonus issue as a healthy sign of the company's financial state. They expect that the company's profitability is going to increase, and hence the dilution of earnings on account of additional issue of shares will be offset. Thus, a bonus share carries informational content about the company's state of financial affairs. Issue of bonus shares is also viewed from improvement in future dividends by the shareholders if a company is paying fixed dividend per share.
We shall now learn about the rationale behind issuing bonus shares from both the company's and shareholders' perspective. There are various reasons from a company's viewpoint. These are: bonus issue of shares brings market price of the share within a popular range for active trading. It increases the number of outstanding shares, that means the trading activity will increase. It boosts the reputation of the company. It also helps in conservation of cash, which can be employed in profitable investment opportunities. Thus, earnings are retained in the company, and on the other hand, shareholders are satisfied by getting bonus shares. But in India, shares cannot be issued in lieu of dividend. Thus, this reason is weak enough to support this reason. In situations of financial difficulties or a contractual constraint to pay the dividends, bonus issue can become savior to maintain the confidence of the shareholders. From the shareholders' point of view, there are many advantages. These are: An investor can sell the bonus shares and incur lesser tax on capital gain receipts, keeping intact the principal shares. But as per Indian law, capital gains are taxable while dividends are tax free. A bonus issue carries informational content about company's state of financial affairs. Shareholders perceive a bonus issue as a healthy sign of company's financial state. Issue of bonus shares is also viewed as an improvement in future dividends by the shareholders if a company is paying fixed dividend per share. Bonus issue helps in increasing the value of the company by preserving the cash to be used for future investment projects. The disadvantages of bonus issue are no effect on shareholders' wealth. It is merely an adjustment of past earnings and an increase in the number of share certificates. It does not give additional benefits to the shareholders as the earnings are just being distributed to the same set of investors but with wider base in paid up capital as the ownership is proportional. Also, the issue of bonus shares calls for printing new share certificates, thus, it is costly to administer the bonus issue. When a company announces small bonus issues frequently, it is not easy to capture the growth in earnings per share.
The bonus issues are governed by following regulations. The bonus issue has to be made out of free reserves made from actual profits or share premium received in cash only. A bonus issue cannot be done in lieu of cash dividend payment. A bonus issue cannot be done on partly paid up shares. A company should attend to servicing of fixed deposits, debentures, and other statutory dues before bonus issue of shares. A bonus issue should be authorized by the Articles of Association.
The third form of dividend is share repurchase. It is relatively a newer concept. Share buybacks or share repurchase is a transaction in which a firm buys back shares of its own stock, thereby decreasing outstanding shares, increasing EPS, which often lead to an increase in the stock price. Stock repurchase has been permitted in India since 1998. The shares bought under this scheme are known as treasury stock. There are two methods of share repurchasing: tender offer and open market options. In the first method, a company offers to buy back shares at a specific price during a specific period, which is usually a month. Under the second method, a company buys shares from secondary market over a period of 1 year subject to a maximum price fixed by the management.
Share buybacks or share repurchase is a transaction in which a firm buys back shares of its own stock, thereby decreasing outstanding shares, increasing earnings per share, and often increasing the stock price. Stock repurchase has been permitted in the 1998 in India, and companies do take advantage of this program. The shares brought under this scheme are known as treasury stock. The idea, if the firms don't have sufficient investment opportunities in future, the surplus funds can be distributed to the shareholders either in the form of share repurchase or dividend payments. If in theory, we assume that the personal income taxes on dividends and transaction costs on selling and buying of shares are absent. Therefore, the investor will be indifferent to both the alternatives of distribution of earnings. A share repurchase will decrease the number of outstanding shares, which will in turn increase the earnings per share and dividend per share. The market price will increase following the suit. Therefore, the appreciation in market price will be equal to the dividends to be received.
In this module, we have learned that dividend decision is an important decision for a firm. We have also discussed the issues that the management has to address while distributing dividend. Further, we have learned about the different types of dividend policies. Retained earnings are favored as external cost of equity is high. One class of investors prefer dividend, while the other prefer capital gains. We've also studied about the three forms of dividends: cash dividends, bonus shares, and share repurchase.
Let us now recapitulate what we have learned in this module. Dividend decision is an important decision for a firm. The firm has to maintain a balance between its dividend payout, investment, and financing decisions as they are integrated to each other. Retention means whatever is left for the company after the payment of dividends. There are two schools of thought when it comes to dividend. Number one, dividend payment does not affect the value of the firm. Number two, dividend payment does affect the value of the firm. Some investors prefer dividend on account of certain principles that capital gains in future. Dividend is considered as a passive residual in residual theory. This theory suggests that earnings should be retained for future investment opportunities rather than paying dividends, as issuing new equity attracts huge costs. There are different forms of dividend payments: cash dividends, bonus issue of shares, and share repurchase. Bonus issue involves issuing new shares to the shareholders on a pro rata basis and involves recapitalization of reserves and surpluses with no effect on the face value of the share. Share split means shares are increased in shares on pro rata basis with a split in the face value. Shares buyback or repurchase are alternative to dividend payments. Companies buy their own shares at a higher market price for various reasons and give cash to shareholders.